First Speed Insights event. I'm Ian Ferguson, co-head of Nedgroup Investments Cash Solutions. Sadly, we couldn't host our annual Treasurers Conference this year, perhaps later in the year, or this may be the event to become the norm. Our Insights event will be informal. Hopefully all the tech works today for the next hour. You have the speakers and all their bios attached in the presentation sent to you yesterday. Nedgroup Investments Cash Solutions is proud to say that during the lockdown period, we've continued to operate without any glitches, with our entire team working remotely. Our clients have been able to operate seamlessly in transacting with us on a daily basis via three ways, i.e. they've been scanning and email transactions to us, or telephonically talking to us, or via our online secure site. The secure site withdrawal functionality is used by many clients. We really encourage clients to use that online facility. We will be launching online deposits, which will happen later in June. Please try and use it and speak to any of our team members. During the period, we've continued to grow our cash book. Our cash book has grown by excess of 25 billion year to date. We've done more than 350 billion rands worth of transactions, and that was up until the end of April. Our fund ratings, as you know, we have 4 funds, were all reaffirmed on the 1st of April 2020. Our Prime Money Market Fund has got a AAA rating. Our Core Income Fund has a AA rating. This fund currently sits at AUM of 51 billion. Our Money Market Fund of 19 billion has got a AA plus rating. And our Corporate Money Market Fund with 46 billion of assets has a AA plus rating as well. Yields have still been very attractive despite the 200 basis points cut earlier. Our expectation is that we're probably going to see another 50 points cut later this month. Just a reminder on the Cash Solutions proposition. Same day value of funds. Obviously, it's a diversified asset base with 98% of all assets that we hold for clients sitting in the banks, highly regulated instruments, the low cost of Bell to operate through us, and obviously our cash desk is available at any time for people to transact. Just a reminder that, and we've got Phil and Gita on the line later from BlackRock, but any dollar demands can clearly be met and we can talk to BlackRock. And we obviously still have a relationship with EcoBack for any African initiatives that our clients are looking for in terms of placing cash. That's pretty much all from me. My colleague Sean Siegel will be hosting the rest of the event. And I'd like to hand over to Nedbank Chief Executive Mike Brown. Mike has always been available for us. And Mike, we once again thank you for being available to stage. Mike's topic today is the banks and the financial systems they operate in. Mike.
Great. Thanks, everybody. Good morning, and I hope you can hear me clearly. As Ian said, I'm sorry that this isn't the 9th edition of the actual Treasurers Conference in Sandton. I haven't missed one, and I'm sure this will be a really, really good substitute. Hopefully a bit like the Springbok bomb squad at the World Cup off the bench. So, as Ian said, in the next few minutes, I'm going to share some thoughts on the financial system and banks in the current environment. Much of this, I'm sure you will all know, but hopefully I'll highlight some insights that you don't currently have. So let's just start with the financial and banking system in South Africa. I think just to reiterate, we're extremely fortunate to have a system in South Africa that works well and a system that's been tested in many crises. And in all of these has performed better than most global banking systems under times of stress. So why is that? What causes the system to work like it does? A number of points. I think firstly, we have and continue to be a system that is well regulated. And I'm going to talk a little bit more later around the proactiveness of macro-prudential regulation, but I think that's a foundation. A second foundation is that the system has been able to earn reasonable returns in a vanilla banking environment. So the system hasn't been forced into more and more exotic instruments or higher and higher degrees of leverage, both of which we know in times of stress generally cause more challenges. The third item is also an extremely important one. Exchange control has lots of negatives, but one of the major benefits of exchange control is that the rand-based funding pool across the financial system in South Africa is a closed system and is balanced daily by the clearing banks and the Reserve Bank. So you just imagine how different that system is to being, for example, the treasurer of a bank in Paris, a euro-denominated environment. You don't know during that day whether the pool of euros is going to end up in, Paris, Frankfurt, Greece, wherever it might be. There's, the money can move very quickly across jurisdictions and countries. Our money stays stable. And we've seen that in every single financial crisis that I've certainly had the oversight of. Able is a good one to think about. So what happened in Able? There was a lot of stress in the system. All that actually happened at the end of the day is the money that shifted out of Able eventually ended up back in the big clearing banks, who put that money back at the SARB, and that same money was effectively used in the bailout mechanism of Able. So that the stability of the overall RAND funding pool is absolutely vital. We have a banking association that is very effective on industry matters, and that's been meeting weekly and works well. And we have banks that work well together. Again, I think Able is a great example of that, where we effectively created a resolution mechanism for Able before any of that existed from a legislative point of view. So in the current environment, we have the National Treasury, the Reserve Bank, the Financial Services Conduct Authority, and the Banking Association meeting weekly to discuss any topical issues. And the Reserve Bank is also meeting weekly with the treasurers of the big five clearing banks. The SARB has been incredibly proactive on the regulatory front. And you see globally, regulators responding proportionately to the circumstances. They're careful not to use all of their ammunition too early. So many of them still have other things that they can do. So what have we seen? You'll know most of these, but we've seen a reduction in the liquidity coverage ratios, the minimum of that from 100 to 80%. And that's not about the overall liquidity in the system. I said earlier that the RAND liquidity pool can't go anywhere. But in times of crisis, what you see is bank clients shifting their deposits to the shorter end of the yield curve, which is quite natural. They don't know when they're going to need them for operational purposes, et cetera, et cetera. But then, the reverse of that is obviously the tension in the dropping of interest rates and the steepness of the yield curve. But as deposits shift towards the shorter end of the yield curve, what that really means is banks have to hold more and more assets in what's called high quality liquid assets, and all things being equal, less money available to support the real economy. So dropping the LCR effectively enables banks to be able to support the real economy and not have to put those excess deposits that come our way into high quality liquid assets. We've seen reductions in capital buffers. Capital in banks is built up in good times, and we've done that, and it is meant to be used in bad times. That's exactly what Kuben, the head of the Prudential Authority, said. So you would expect to see those buffers that have been dropped enable banks to use that capital in these more difficult times. We've seen a guidance note on dividends, which is to preserve capital in the system. And we've seen a directive on restructuring of problem accounts, effectively saying that if somebody has an account that's up to date and it's only the COVID matters that are causing them to have cash flow challenges, when banks restructure those accounts, they don't have to move them down regulatory buckets. And when you move down regulatory buckets, it increases capital, and you don't have to move them down impairment buckets if it's only COVID related. So it's an attempt, as we see all over the world, to reduce what's called pro-cyclicality. And that applies across both our retail and corporate portfolios. And then this week, we saw the launch of the 200 billion Rand SME scheme. The first 100 billion of that was launched, which is really the National Treasury acting through the SARB and using the commercial banks as a distribution mechanism for this, intended to try and increase the velocity of money supply across the system. All of those loans that the banks make will be 100% funded through a special repo, so it will have no impact on the overall funding system. And the loss sharing arrangement has been agreed at 94% to National Treasury and 6% to the banks. And there's still more in the regulator's armory in need. We've seen significant changes to the repo system. Now, this is complicated stuff that not many people follow, but it's important. The banks have to own high quality liquid assets in terms of our prudential requirements. And one of the things that we do with those is that we pledge them to the SARB to the extent that we have to participate in the repo mechanism. So what did we see happen? On the 20th of March, the Reserve Bank introduced 2 daily supplementary repos, one at 10 a.m. and one at 1 p.m., which was a really strong signal to say that the SARB is happy in this environment to inject liquidity into the system on an overnight basis. And that is the role of the SARB. In addition to that, they also agreed to maintain their usual 7-day repo in place, meaning that the supplementary repos are truly supplementary. And then they encouraged banks to clear more amongst each other by reducing the rate that banks earn that when we deposit money back with the SARB to repo minus 200. And then from the 25th of March, they added a longer dated weekly repo with tenor of up to 3 months and the ability to extend that to 12 months. So significant action to ensure that the system from a liquidity point of view works well. And I suppose the test of that is that if you look what happened in the last week or so, the SARB has now recently removed the 10 a.m. supplementary repo, effectively as a signal to say there is some normality returning back to that environment, and it has worked well. The banks themselves enter this crisis in much better shape than the global financial crisis. We don't know the extent and depth of this crisis. We also didn't know that at the time of the global financial crisis. But for the global financial crisis, the banks were the cause. Here, health is the cause. That impacts the economy, and then obviously the economy impacts banks. But at the same time, governments and regulators know that banks are part of the solution in helping our customers and clients with cash flow shortfalls through this crisis. The capital levels across the South African banking system are roughly 40% higher than they were at the time of the global financial crisis. So if I just take Nedbank as an example, we entered the global financial crisis with a CET1 capital level of around about 8%, and that was fine to get us through the global financial crisis. We enter this with a CET1 of 11.5%, an LCR of 125%, a net stable funding ratio of 113, and sources of quick liquidity across the Nedbank balance sheet of in excess of 225 billion rand. So we don't know how long this lockdown is going to last. We heard last night that, hopefully large parts of our country will move to level 3 by the end of May. And I think equally importantly that we get some material changes to what is or isn't allowed under level 4. There are very definitely challenging times ahead for our economy. We all know that. And as a result, for banks and the banking system. But the banking sector, working alongside our regulators, is well prepared to play its part in managing through this crisis and using the buffers that we've built up to help our clients to do the same wherever possible, and in so doing, helping the economy to recover and saving jobs. Thank you.
Thank you for that, Mike. I'm Sean Seeger, and as Ian mentioned, I'll be hosting the rest of today's call. I just seem to live at work these days. Sounds quite good to say that in front of the boss. Truth is, like most of you, I'm just working from home. But with all this extra time, I looked up your previous topics, Mike, of the talks you've done for us over the past few years. And in 2013, your topic was challenges for banking in the new normal. And yeah, all I can say is good luck in facing the challenges of banking in the new normal. Thanks again. We're going to move over to JP Landman now. He's another regular at our Treasurer conferences. And JP will be giving us a brief political overview. Over to you, JP.
Good morning, Sean. Thank you very much. Good morning, everybody. Can I just check, is the sound okay?
We can hear you. Yes, that's
good.
That's great.
Okay.
Go ahead.
Thank you. Look, I want to talk about 3 topics this morning in this little slot. The first one is how safe is Cyril Ramaphosa? What is his political position? Is it strong? Is it weak? Could he be toppled? I want to talk about his political position. Secondly, I want to look back at the major economic decisions we had since the budget. The budget was 2.5 months ago, and this is a look back. It's not looking forward about what we think will happen. It is also not what should happen. We leave that to the economists. It is simply what has happened and what we learned from it. And then the third and last topic, if we have time, is what I think the President's two priorities are that he's going to focus on over the next 18 months or so. So those are the three things I'll talk about this morning. First of all, how safe is Cyril Ramaphosa? And I raised this topic, Sean, because a number of absolutely insane WhatsApps and emails have gone around in the last 2 weeks or so suggesting that Cyril will be replaced, suggesting that there was a secret ANC National Executive Council meeting where he was outvoted and so on and so forth. Normally, I don't pay any attention to this rubbish, but because of the sheer volume of it going around, I thought it is good to respond to it. And the short answer is none of these allegations are true. I think Cyril Ramaphosa is standing stronger than ever since he's been elected 29 months ago, 2.5 years ago. As you know, he was elected by a margin of 52% to 48%. Now, you can just play yourself a little game and ask yourself, is he standing stronger or weaker than 52, 48%? And I think the overwhelming answer must be that he stands much, much stronger. You can see that from observations of the political scene. You can see that from poll numbers that come out. Before the lockdown, we had an Ipsos Markinaar poll, the most experienced polling people in South Africa, and they found that his popularity at that stage, before the lockdown, was sitting at about 62%. It was about 10% higher than the popularity of the ANC as a political party. Now, this is very, very important. No political party is going to dump a leader that is more popular than itself, simply because there's security for you as an ordinary member of the party in that leadership. You want to win the next election, you want to become a councillor, you want to become a member of parliament, or whatever your political ambitions are, you can't afford to have a leader in your party who is not liked by the general population. So I think that 62% number before the lockdown is important. But since then, we got an opinion poll out yesterday, which was done by the University of Johannesburg. They've measured the public's approval of Cyril Ramaphosa for 3 weeks, 3 different weeks, 3 successive weeks during the lockdown. And what came out of the poll is that 82% of South Africans think that Cyril is doing a good job. Now, it's one opinion poll. One swallow doesn't make a summer. But if you put all the evidence together, I think it's quite clear that the man is quite strong and he's not about to be toppled. You also have to consider 2 other things when one talks about his political position. And the first one is to remember that parties do not change horses in midstream, unless it's quite clear that the stream is going to wash the horse away. The DA last year decided to change horse in midstream, and it didn't go too well for them. Political parties don't do that. Political parties tend to close ranks. They tend to form a lager, almost, so to speak, until the crisis has passed. So there is simply no way that Cyril will be challenged or kicked out either during COVID or after that. Some revolutionary things would have to happen to do that. The last question to consider under his position is who else? Who else? I mean, you can't seriously suggest that Ace Magashule will be elected by the ANC. They won't. You can't seriously suggest that Mrs. Zuma, who's associated with the cigarette debacle, that she's going to be chosen. Now, I think he's standing stronger than at any time since his election 2.5 years ago. He solidified his position with the COVID crisis, and he's well placed. Having said that, I must just point out to you that in February, George Bush got 92% approval ratings. 10 months later, in November, he lost the election to Bill Clinton. That was in 1982 in the US. So yes, you can go from 90% approval ratings to losing an election. It can happen. But I don't think we're anywhere near that position in South Africa at the moment. So in conclusion, on the point about CR's position, let me say this. I think the speculation is based on over-interpretation and under-analysis. I'll say that again. It is based on over-interpretation and under-analysis. If you analyze the situation, I think we're talking about stable and good, strong political leadership. Now, that in a sense has a bearing on the second topic I want to talk about, and that is looking back to the budget and where we are now. Now, the budget was only 11 weeks ago, and we all know what has changed. But let's just run through the list. In the budget, it was said that salary increases for this year will be limited to 1.5%. April, the new salary year, has come and has gone, and actual salary increases were null. Not 1.5% as provided in the budget, they were null. The unions have been shouting fire and brimstone, threatened to go to court and so on. To date, no court papers have been lodged. Of course, they can still come, and then the matter will be in the hands of the courts, and we've got to work through that. But if you look for political will, the political will is in the fact that the budget said 1.5%, the actual was null. Secondly, South African Airways asked for more money. The business rescuers did. They were told no, they can't have more money. SA Express was allowed to go insolvent, and private sector advisors, I did yesterday, have now been appointed for the Land Bank. So the Land Bank is not just getting money or just getting a guarantee from Treasury. They now have to work through their problems with the help of a private sector advisor. I think all these things tell us that there's a shift that has taken place. Not really a shift, it's a holding of the line as far as prudent fiscal policies go. That was confirmed in the monetary and fiscal reaction to COVID. The COVID recession, or the COVID depression, if you want, means that the South African economy will probably contract by something between 8 and 10%, the economists will tell us. So you want a response package that is more or less equal to that. Well, the response package in South Africa was 7.5% on the fiscal side, and whatever you think the monetary stimulation was, difficult to calculate that in numbers. Now, if you have a 7.5% fiscal stimulation against 8 to 10% contraction in the economy, you're doing your bit. You're not going overboard, and in fact, that is what the left is criticizing the government for very strongly. While I think most other people will accept it's a fair and appropriate response. It is important to take note of the position of the South African Reserve Bank through all of this. There was no political pressure. There was absolutely no political pressure on the bank to do anything around modern monetary theory, to print money for government expenditure, anything of that sort. The government has taken a strong, consistent, and conservative line. And you've heard from Mike in his introductory comments what a fine banking system we've got, and it speaks to the quality of monetary management. There's also now, lastly, a decision to go to the IMF. The only people who really argued about that was Ace Magashula and virtually nobody else. Members of the chattering classes tried to talk this up as a big test for the rationality of the government. Well, we're now applying to the IMF, the World Bank, and the BRICS Bank. So what do we learn from these instances? Why do I quote them? I quote them because Winston Churchill said, if you want to look forward, look backwards. And the further backwards you look, the further forward you can see. If we look back to the budget and where we are now, what you see is a consistent line of what I would call, if not conservative, certainly middle of the road thinking. Certainly middle of the road thinking in both fiscal and monetary policy. And that tells you where the political leadership in the country is, and it gives you a very good indication of where we're going forward. I'm seeing my time is running out. I've got only 20 seconds left. So let me just say this about my third point, the presidential priorities. I see two priorities. It's coming out clearly from his various statements, and that is the economy. The economy is absolutely number one for Mr. Ramaphosa. And he's going to do everything that he can to get economic growth back. I don't have the time, but we can talk about the detail we can expect there. And secondly, there you can hear my alarm is going, the 10 minutes is gone. His second priority will be to build a more capable state. That is, of course, a huge and a long task, but it's quite clear from interactions in and around the union building this is a major, major issue for the president and this government. And maybe one of the benefits of the COVID pandemic, if I may abuse the word benefit, the realization that we really have to up our game if we want to go anywhere. So that's what I have. Thank you very much.
JP, thank you for that. Thanks for sticking to time. We could listen to you a lot longer. And we are hoping to get JP back for a longer session, a more detailed political roundup pretty soon. We'll let you have the details for one of the future insights. As you know, we have a relationship with BlackRock on not only on our money market and liquidity side, but also across the rest of our business, especially on the core range. And it's a wonderful relationship. The numbers BlackRock talk are always staggering. Phil mentioned to me yesterday that they'd had $100 billion net inflow just into his franchise alone, just over the COVID period. So we're very privileged to have Phil Curley on the sales side, sales director for the BlackRock liquidity strategy, and Geeta Sharma, who's the portfolio manager of the US dollar liquidity strategy that we have registered and distribute down here. We're happy to have them join us. Phil, if you can take us through your side of things and then introduce Geeta.
Yeah, morning. Thank you, Sean. I'll just check you can hear me as well.
We can hear you loud and clear.
Fantastic. Okay. So morning, everyone. I think first and foremost, I hope this finds you all safe and well. And thank you very, very much for the invite again, Sean. Right, so you have us for about 10 minutes. As Sean just said, I'm just going to touch on the fund and give you an overview of the fund that you can access via the Nedgroup team, and then my colleague Geeta Sharma, who runs the fund. She's the lead portfolio manager. Is going to give you an overview of the market and the current positioning. Right, so the fund. When we talk about the fund, this is a short-term money market fund. It's in dollars. And it's what we see clients using rather than a traditional call account, a bank call account when they're holding US dollars. The investment objective, first and foremost, capital preservation and liquidity, but you will typically see a pickup on yield using this fund over a bank account. Just a little bit about the fund, because it's slightly nuanced, I think, to what you will be familiar with the RAND fund. Just in terms of rating, it is AAA rated. It's AAA rated by Moody's, S&P, and Fitch, so the three rating agencies. The framework, the regulatory framework, the fund is classed as a low volatility NAV fund, which means when working within strict criteria, the NAV of the fund will always be 1. The structure, it's a UCITS fund. It's domiciled in Dublin, in Ireland. And it's importantly for you, it's Section 65 approved. The duration, the fund has a maximum weighted average maturity of 60 days, and the weighted average life would be a maximum of 120 days. And then the final maximum maturity would be 13 months. Liquidity, the fund will hold a minimum of 10% in daily maturing securities, and 30% will be in weekly maturing securities. So a very liquid fund. In terms of credit, the holdings, very traditional money market securities, but typically banks. And the important bit being the minimum rating of those banks would always be a minimum of A1, and that's by S&P. Very diversified. A maximum of exposure to any one issuer would always be 5%. In terms of dealing cycle and cutoff, we have two options. We have a distributing share class, which gives investors same-day access, so instant access to funds, or we have an accumulating share class, which is T1, so next day. And the dealing cutoff, a nice late dealing cutoff, so beneficial operationally, 5 p.m., and that's New York time. The current AUM, it's 41 billion in size currently, and the yield, this is a net yield to give you an indication, just over 50 basis points. Just on performance, no doubt the markets have been through in a period of extreme stress, but the fund performed impeccably well, and it's done really exactly what it's supposed to have done over the last 2 months in terms of meeting all redemptions and taking in subscriptions. Now, just before I hand over to Geeta to talk a little bit about sort of the markets and positioning, I was just looking at some notes. So I spoke at this conference last year. Rates were over 2% at the time. We were talking. The talk then was around the standoff we were seeing between the market and the Fed. The market had very much built in rate cuts at the time, but the Fed were using words like patience and being data dependent. It was then all very much about Trump. Trump was upsetting most people, trade wars, and we were talking about Brexit. That certainly seems like a very long time ago now, and relatively normal to how we find ourselves. Although I think that Trump may be the one consistent that we do see. On that note, I'm going to hand you over to Geeta now to give you some color on what's been happening. If we can do that in 5 minutes, what we're seeing and how we're currently positioned. So Geeta, over to you.
Thank you, Phil, and thank you to Sean and the Nedgroup for having us along today. Just as Phil mentioned, I'll just cover sort of a quick update on market developments and backdrop, and then really talk about the fund strategy. So leading with that, the current market environment, unsurprisingly, is very much impacted by the fallout from COVID-19. It's affecting us all in our daily lives and really driving markets as well. I think the key thing here is that the US Federal Reserve were one of the very first and still are a leading central bank in terms of a response to the current risks associated with the virus outbreak. And they've done a number of things to really support markets, support businesses and support households, recognizing that they need to do much more than just adjust policy rates. So the first thing is that they did adjust policy rates, and they were very quick to do this, actually cutting outside of their scheduled meetings twice in March, which took the Fed funds target range now to 0 to 0.25%. So we are at historical lows in US interest rates, and they feel that is the appropriate response in light of what's happening. In addition to that, they've done a number of other things. One is that they've increased asset purchases, so it's really to support liquidity in the market and to keep rates low. They are also they have announced and continue to highlight their support to do further in this regard, liquidity and credit facilities, which are really to ensure that there is super efficient market functioning given the risks around the world, and also ensuring that there's support going directly to businesses and households who need access to credit at this time. And in addition to that, they've also alleviated some of the regulatory requirements for banks and other institutions to really support the monetary transmission mechanism. This is either all tied together, and we heard from Chairman Powell even yesterday. He gave a speech where he indicated that this could be around for the impact of this could be around for a lot longer, and the need to be supportive therefore is underlined, and so they would do more if required. I think for now we believe that interest rate cuts that have been enacted are limited in terms of where they could go further. They don't seem to be supportive of a negative interest rate policy. They do believe that these other facilities and what we call non-standard tools non-standard tools are preferred over the traditional tools, and will be more effective in the results to get both employment up and inflation up towards their target levels. So what has happened as a result of all of these changes is really that US dollar yields have continued to move lower since mid-March, and we're now approaching historic lows. So one of the key measures that the market follows is 3-month US dollar LIBOR levels, and that is now sitting below 40 basis points and had been at over almost 1.5% at the end of March. So a very quick adjustment. We continue to see pressures on yields coming lower because of this accommodative stance from the central bank. And for that reason, the investment yields in which we are investing are also moving lower. But one thing we are doing is employing more of a barbell strategy in the funds. Now, what that really means, and Phil alluded to the need to hold liquidity, what we are doing is holding larger amounts of liquidity. So you mentioned, we have to hold 30% liquidity in 1 week. That means essentially we've got investments maturing in the 1 week space to meet ongoing uncertain liquidity requirements of the underlying investors, we are holding actually closer to 50%, so well in excess of the minimum requirements. And that's really because we do feel that that's the appropriate way to be positioned in the current environment. But the barbell is that we are also balancing that with longer dated holdings, and those are at higher yields and therefore will protect the overall net yield of the funds, all else being equal. And so that is sort of the key kind of strategy at this time. In addition to that, we are also, because of the support from the central bank, we've seen a very, very sharp tightening in credit spreads across the board in the money market space. But we do believe that macroeconomic risks are still quite high, just given the risks relating to the virus, the lockdown, and how quickly we return to some level of normal activity. For that reason, we continue to be biased towards high quality investments. So typically, Phil mentioned the minimum requirements from a credit rating standpoint, A1, P1, but we've actually, even ahead of this crisis, again, due to credit premiums being much lower than we would otherwise want them to be, have been preferencing higher quality sovereign type investments. We're also holding a vast amount of US Treasury bills in the portfolio. So almost 20% of the holdings in the funds are now in what we'd call sovereign and sovereign-like investments. So a very high quality tilt in the current environment. Overall, the sort of duration or weighted average maturity of the portfolio, the funds, is quite neutral. Again, this is just because we're really focused on maintaining liquidity at this time. And having managed through many crises myself in the past, I can say that this has always proven to be a more successful way of operating, because as we are in an uncertain environment, it's very difficult to evaluate how both market conditions but also liquidity needs of investors can evolve. So this is the reason for positioning in this way. And as Phil mentioned, and also Sean mentioned, we're continuing to see flows into prime funds generally, because we do still think that these yields are very attractive relative to where US dollar cash investments are generally being offered at this time. So with that, I will close and perhaps hand back to Phil for some final comments.
Geeta, thanks. It's Sean here. Thanks so much. Just to remind everyone on the call that if you do want regular updates from the BlackRock liquidity team, they do these every 2 weeks. They're outstanding. And if you would like to be included, just give Ian or myself a call and we'll make sure that you're added to those calls. Now, as you know, Phil and Geeta have been under lockdown, much like the rest of us down here. The difference in the UK is that the bottle stores are open and they're allowed to buy grog. And Phil made the comment yesterday to me. He said, heck, Sean, if these pubs don't open soon, I'm at risk of becoming an alcoholic. So, Phil, I hope the pubs open soon so you don't become a home alcoholic. Thanks again. I'm now going to hand over to Jones Gondo. Jones is a credit expert with us, with the bank at Nedbank CIB. And credit obviously very much a part of everyone's mindset at the moment. So over to you, Jones.
Thank you, Sean. Thank you for having me. I'm going to jump straight into just giving you some context of, picking up from what Geeta and Phil were saying, is that, look, we find ourselves in a macroeconomic environment with high systemic risk, a lot of uncertainty and skittish financial flows, which have the potential to have contagion effects that can threaten financial stability. So we've seen all the central banks basically put in liquidity backstops, even here in South Africa, essentially, as Mike explained, to basically ensure that the financial plumbing in the short term is functional and that panic eases. But, where ratings and rating agencies, I suppose, the trick in communication is that they try and look way beyond 12 months, 24 months beyond the current crisis that we see. And most of the market is really concerned about, the right now. And so we see that, as lockdowns are starting to ease and we will now contend with a wave of new information about how the operational statistics of the real economy are faring, and this is when we start to see it primarily through the banking system, as Mike explained, that non-performing loans and higher provisioning within the banks starts to feed through. And I think this is important to understand because at the end of the day, we've seen, particularly in the case of South Africa, 2 rating downgrades from Moody's, one from Moody's, one from S&P. And this feeds into the banking system in 2 ways. One is obviously the ability to raise money in the markets, particularly on the dollar side, becomes far more expensive now that we're speculative grade. But inside banks themselves, they use their internal rating systems, which will show a rapid deterioration in the creditworthiness of individual counters. And this, cannot be. On the one hand, the central bank has tried to give relief on capital and liquidity, but rating migration risk is something that results in pricing for credit in the market that has higher spreads. So whilst your policy or baseline rates might be coming down because of easy financial conditions, credit risk becomes quite heightened, and so still we worry about the pace of credit and money supply going into the economy to generate growth. And under this kind of scenario, we would expect beyond rating downgrades from the sovereign that we'll start to see in the next 6 to 12 months idiosyncratic downgrades on corporates themselves based on lower earnings, access to liquidity in the markets, and higher cost of capital. If I take a step back and just kind of look at South Africa's sovereign rating history, S&P has us a BB- with a stable outlook, so they have looked at a wider deficit already of minus 13.3%. That's what they're clocking in when they did the downgrade, and they're quite concerned about the lack of stable portfolio inflows coming into South Africa, not just right now, but looking into the future, and how they'll fund that deficit. And so they've taken their action. When we started when South Africa first was rated in 1994, we were at BB with S&P. So we've never been this low with S&P. We were much lower than when we started. Similarly, with Moody's, we started our rating at investment grade at Baa3, and now we're sitting at Ba1 with a negative outlook. Now, I have a strong conviction that Moody's is not done yet with South Africa's downgrades for this year. We still think that the downgrade that happened now had to do with the sudden stop in the economy. We saw the revisions in growth, and of course now we have wider deficits. But the drivers of negative credit deterioration at Moody's over the last 12 to 18 months are still in play, and that is the real inability to implement reforms is still weighing on us. As we entered into a recession prior to COVID, and finally, it's just now the real impact of credit deterioration in state-owned companies and the contingent liabilities. We've heard land banks default. We still have fiscal pressure from Eskom on the budget, and SAA continues to, I suppose, still be a contingent liability, depending on what sort of strategy is put in place to either start a new airline or to just liquidate the airline as it is. And the whole ecosystem in the airline industry seems to need some level of support. If SAA is not working, I'm sure we start to look at all the other infrastructure around aviation and see where they come out over a 12-month horizon. So the credit outlook still is very much negative on the sovereign side. And we can see that now, even after, if I just touch on just looking at flows and asset prices. We've got a very steep yield curve at the front end. It goes from 3.7% at the R208 and peaks at the R2044 at 11.2%. So it's if all corporate treasurers are trying to look and say what's the risk-free rate to put into my weighted average cost of capital, it's quite high at 9.5% if you take the 10-year R2030, and this is how essentially a wider deficit is being priced into the yield curve, really increasing the expected return. So the government ends up crowding out the potential for private investment and capital growth. And the final bit that I want to touch on is just to explain that even though Moody's has done its downgrade and we're out of the WIGB, does it really still matter at all? And I think it does in terms of the size of outflows size of inflows that we need to attract to fund a wider deficit. Just looking at the fact that in the month of March, we had net outflows of about almost $3.6 billion. And on specifically on the 12th of March was the biggest daily net outflow that South Africa has experienced. I'm looking at IIF data. It was $722 million, about 11.5 billion rand on one day. And this preceded a Moody's rating action by 2 weeks. And so, we going into that, we thought that the index trackers or passive money would have been around between $700 to $1 billion. And everyone was waiting for the final exit rebalance to see some big outflows, but it's difficult to tell, but the size of outflows that preceded this downgrade seems to me to match what we would have expected. And the impact on that day, essentially on the market, was 60 to 70 basis point climb in the R2030 benchmark bond towards 10% handle. And on the USD Rand cross rate, it was a 2% depreciation towards 17 to the dollar, 17 Rand to the dollar. So the reality of the matter is that because the passive money is now out, South Africa now has to fight, like every other emerging market, for a dwindling amount of US dollar liquidity out there that would be looking for carry trade coming into markets like South Africa. So beyond our high real yields, we have to do a little bit more in terms of telling a story that we are willing to be reformers and we are willing to have fiscal discipline. And that should help flatten the curve and fund this deficit and lower cost of capital in the economy in the medium to long run. And so I'll leave it there, and I'm sure we can have interactions about with all more questions later.
Thank you, Jones. Very well put. I'm sure you've got your hands full now and for some time ahead, so appreciate your time. I see Nikki is on the line. We're very lucky to have Nikki, another regular of our Treasurer Conference and other events. Nikki, I know you've got a heck of a full schedule, and I think we managed to snatch you in a 15-minute window today. I'm not going to use up your time, so over to you.
Hello. Just to confirm, everybody can hear me?
Yes, you sound great.
Okay, great. All right. So, yes, I mean, listen, my brief today for all of you is that I was told to be brief, so I'm going to do just that. I thought it was best I use this opportunity to kind of talk you through our forecast. I don't think I need to tell all of you that COVID-19, the pandemic and the lockdown measures that we've seen will cause considerable damage, not only to the world economy, but to South Africa specifically. But I suppose the question you would really want answered is not that it will be bad, but how bad is bad. So that's kind of what I'm going to focus on, to give you a little bit of context. So to answer that question, how bad will bad be? Well, at the risk of sounding like an economist, I would have to say it depends. And on what you may say, will it depend? Well, on how long the lockdown lasts and whether the easing of restrictions the president announced will be announced in the coming days will indeed be sensible. And I think one of the biggest problems in the case of South Africa is the nature of the lockdown. The way we have implemented the lockdown has been unique. This is not something that has occurred in the rest of the world, even though we keep saying that we are following the rest of the world and we are following good advice. When it comes to the economic side of the equation, we certainly haven't done so. And because it is unique, it's also therefore been uniquely damaging. So we focused our lockdown measures on which products are allowed to be sold and on which industries are allowed to operate without really taking in consideration that supply chains run across multiple products, across multiple industries and sectors. So as such, even the easing of the restrictions as we went from level 5 to level 4, for example, have not really helped to bring about any meaningful increase in economic activity. It's almost just as bad as staying into level 5. So what's the problem here? Let's use the example of an automotive manufacturer, a motor vehicle manufacturer of fully built up vehicles. Under level 5, they were not allowed to operate at all. Under level 4, they can now, in theory, ramp up their production to what is it? Almost 100% of staff capacity. But here's the problem. What's the point in ramping up your production when you already sit with a yard full of vehicles you can't sell because your key outlet, dealerships, are closed? All right. So government has taken that point, and I do understand it was yesterday or the day before they said that motor vehicle dealerships will be allowed to operate. But this is just one example of multiple such cases across the South African economy that's been affected by the regulation that's been written under the lockdowns. So in our opinion, that has probably been the most damaging side of the experience we've had up to date. So if we see sensible changes being implemented, such as e-commerce and the opening up of whole supply chains across the primary, secondary, and tertiary sectors, and we see it with immediate effect in the announcements we are anticipating in the next few days, then South Africa could maybe emerge from this lockdown with at least some semblance of a functioning economy intact. But I think we have to accept that we're going to take a big hit, and we have to accept that the consequences are going to be relatively severe and that the impact could also be prolonged. In our base scenario, we assume that conditions remain depressed in May and that the economy is only slowly and very gradually reopened, and that production and sales are really slow to rise, partly because we're taking this sort of very patchy product by product, industry by industry view of how the lockdown, of easing the lockdown and reopening the economy. So production and sales remain really slow to rise, and it only, in our sort of assumption, gathers momentum around the final quarter of this year. And that brings us to a GDP forecast for this year of a contraction of 7%. And then we see a sort of a gradual recovery off that low base from 2021 onwards. Now, our model, unfortunately, if we put in all of these sorts of assumptions and we use normal economic relationships and, the coefficients between different economic variables, it sort of spits out a model, a growth rate of only around 3% for 2021. And then after 2021, GDP sort of recedes to below 2% in the outer years. So that means that if you contract 7% this year and you only grow 3% next year, that you're taking a permanent hit, and that the damage from 2020, from the COVID crisis that we are currently living through, will be enduring. And that's going to work, in our view, through two channels. Companies facing enormous financial strain during the lockdown will obviously postpone or scrap fixed investment first. That's the easiest thing to do. So CapEx will not bounce back quickly in 2021 because those firms that survive will sit with spare capacity, and demand will also adjust to lower levels. So their incentive under those circumstances to go out there, raise the capital from the bank can expand their operations will be limited. So we think fixed investment will be a big channel through which the weakness will persist in the South African economy beyond 2020. And we see fixed investment actually contracting by just over 16% this year and a further 1% next year, and only really recovering from 2022 onwards. And then, of course, the other channel through which we have the more enduring impact of this COVID crisis is through company failures and cost-cutting exercises. Sadly, it's a reality. If you're a firm and your cash flow is running out and you've got your back really against the wall in that sense, and things are really getting very difficult, ultimately, after you've cut back fixed investment, delayed it, postponed it, scrapped it, you do sadly have to consider job losses, and you do sadly have to consider, scrapping bonuses, reducing pay for many individuals. And it is through this channel that the COVID crisis will have its second enduring effect. We do expect job losses. Our forecast is for about 1.6 million job losses, and we believe it will take almost 3 years before employment levels will return to pre-crisis levels. We also expect that the disposable income will decline in both nominal and real terms, and that will take about 2 years to return to pre-crisis levels. So that means there are less people earning an income, less people with the ability to spend. Those that are still employed and lucky enough to have a job, like many of us, we will all earn less, and therefore we will also have less to spend, and demand therefore will remain suppressed for some years to come. So that is partly the reason we only have that 3% increase in economic activity coming from this very low base in 2021. Now, I know it's a gloomy tale, but I think it is realistic. It could even be worse if there's a second wave of COVID-19 across the globe. God forbid that is the case. It could also be, worse if we continue with the lockdown regulations as they are at the moment, and the easing of restrictions that's been promised continues to remain almost contradictory. It doesn't take into account that an economy is a dynamic organism. It isn't a static organism, that supply chains run across multiple products, multiple industries, and if the easing of regulations are also arbitrary, then you're also going to struggle to get compliance from the public, because the more ridiculous it becomes, the less likely the public is to comply. So things could be worse than they are. So far, luckily, I think South Africans, even among the poorest South Africans, have been incredibly compliant. And I think we all need to just appreciate that for a moment, and the sacrifices many have made, and how compliant South Africans have generally been. So government's had a very compliant citizenship, and hopefully the worst doesn't happen. But like I say, I know, even on our base assumptions, it is a very gloomy picture. But there is some good news. Inflation is forecast to moderate significantly. We recently updated our inflation forecast. One of the things we do is we do a quick survey of our own, of prices, of rentals, and we put it into a sort of a bottom-up model. And I've got to tell you, it's looking very attractive indeed. We think inflation will probably hit a low of 1.7% in June. A big factor, of course, is the big cuts in petrol prices coming through, the reductions in rentals, the drop in interest rates, its effect for owners' equivalent rent, and the fact that food prices, based on our surveys, actually been falling. I don't know if anyone else have experienced anything else. So the bottom line is, inflation falls to 1.7%. It's like we're America. And then it slowly rises to around 3% by the end of the year, and it averages only 2.8% this year. Next year, off this low base, it climbs to about 4%. But what that means is, remember, the MPC, the Monetary Policy Committee, they essentially target 4.5%. So inflation will therefore be quite comfortably below their target range for much of this year. And the reason for this is simple. You've got shrinking demand that will make it very difficult for price increases to occur. It will make it virtually impossible for companies to increase prices without hurting their volumes dramatically. And you've had the collapse in global oil prices, which has been causing a disinflationary spiral. So in our view, that will outweigh the impact of the weaker rand, and we do think that the MPC will therefore focus on growth, and we expect him to cut interest rates again. And in fact, initially we said maybe 50 basis points, 25 basis points in May. But honestly, if you're going to have inflation go down to 1.7%, you expect your economy to shrink even by the Reserve Bank's forecast 6.1% this year, then you might as well cut 100 basis points. It doesn't help or provide any kind of relief if you wait. So we're expecting a 100 basis point cut next week, Thursday. So that should help. As far as the rand is concerned, I know there is that view out there that the rand will strengthen because South Africa offers incredibly high yields compared to your low-risk countries that have cut interest rates dramatically and started printing money and undertaking very aggressive quantitative easing. And this yield advantage that South Africa had should revive the carry trade, and we should see renewed demand for South African government bonds, and as a result of that we should see the rand strengthen. And some of the forecasts out there, they see the rand ending the year at 16.20, 16.30 to the US dollar. Unfortunately, we don't quite share that view. We do think the rand's probably most of the worst news is in the value of the rand. And we think the rand is at its bottom, and the worst is probably over for the currency. And we do see it strengthening a bit, but not to 16.20, 16.30, 16.50 at the end of this year. And the reason for that is, fair enough, the high yield story has always been a South African story. The carry trade has always been a South African story. We've all seen that movie before. After a period where the rand have maybe depreciated very sharply. But for us, this time is a little bit different, because during all the previous rand crises, government's budget deficit was, you look at the global financial crisis, it was a small surplus. Now we expect the budget deficit to surge to 14% of GDP this fiscal year, and to hover around that 10% of GDP over the next 2 fiscal years. Their gross debt burden, as a result, will rise to close to 80% this year and to climb even higher over the medium term. And so we do think that the reality is, if you're a foreign investor, you're looking at South Africa's fiscal situation. Yes, government debt offers a very good return, but it's also enormous risk. Because the only way the government can reverse this is by growing the economy. And I mean, listen, make no mistake, I think they will try the route of higher taxes first. And when all other options have failed, they will consider more aggressively growing the economy. But that would mean that they would have to undertake substantial structural change. And I mean substantial, from energy policy to labor legislation to industry-specific regulation. And the aim of that would have to be to, maybe hurt vested interest. It will maybe not be in the advantage of the politically connected. It will be aimed really of getting rid of the inefficiency, making this economy more efficient and reducing the cost competitiveness of the economy. That is really the only way they're going to get themselves out of the fiscal hole they're in the moment. And that's difficult to execute from a political perspective. So that's why we think that structural reforms in the year ahead will probably be fairly superficial, and it will probably continue to occur at a snail's pace. And so we think that South Africa's risk is re-rated. Our risk premium has increased to a higher level. We will always be a speculative bet, but the truth of the matter is there is just too much risk to SA's fiscal metrics for investors' liking in our view. So we see the rand pulling back, but only pulling back very moderately, ending the year around 70, 80 to the US dollar. So that's our sort of view, and thereafter depreciating at a far more moderate rate. So I'm afraid it is a gloomy story, but I hope that this little quick wrap up gives you some sense of how we see the economy unfolding. And so thank you very much for listening to me. Drone on and stay safe, and hopefully we see each other soon.
Nikki, thanks so much. Certainly not droning on. Thanks for sticking to the brief of being brief. You're actually quite good at the speed dating thing. We are hoping to get Nikki back for a more detailed session, especially with this emergency budget coming up. And again, we'll send invitations as and when we can arrange that. Thanks so much, Nikki. I'm sure you got a lot on your plate as well at the moment. We're going to wrap up today with Ray Wallace. Ray is known to all of you. Ray is the Chief Investment Officer of Taquanta Asset Managers, and they manage our liquidity range, our cash solutions range of funds, and have done so since these funds all started, or since inception of every single one of our liquidity funds. We've been very impressed with the way that Taquanta have navigated these markets, and our funds have done exactly what we would have hoped they would do. Over to you, Ray.
Thanks, Sean, and thanks to everybody for staying on the call this long. As Sean said, the funds have done really well and we've weathered the storms pretty well. We've come through with flying colours, and the funds have actually emerged much stronger and basically ready for what's to come. Our business has actually seen inflows over this period, and our assets under management have actually grown by 20 billion over the last 2 months. And I think what you've seen from the crisis really is that it's been an issue about liquidity. And now that we've been able to get through that sort of liquidity crisis, it's really looking forward and saying what are the real credit risks that are going to arise in the future, and that's because of how is the economy going to do going forward, and we have yet to see what's going to happen there. But the phrase "cash is king" is as relevant now as it's ever been. But everybody on this call, I assume already understands that, and that's why you're listening in. One of the mottos that I kind of live by are that things are never as good as you expect, and they're never as bad as you expect. But it's very difficult under these lockdown conditions to make sure that still applies. So, we need to listen to what sort of people like Nikki have to say on what the potential outcome is and what the real bad or worst case scenario is going to be in the future. I'm kind of more inclined to believe a science fiction writer at the moment than any investment analyst, because really nobody knows what's going to happen in the future. This is something we've never experienced in 100 years, and even then, in the 1920s, we didn't have social media and all the information that we've got at hand now. So things are just in a completely new realm at the moment, and that, in my view, is really why cash is still a great place to be for the next while. It's something that's going to give you the flexibility and the ability to move and adapt to any condition that comes up. So really, as the big question really comes down to is, you're sitting on cash, what do you do with that cash? What are the options to do it? And from somebody like a corporate treasurer's perspective, I guess at the moment there are quite limited options going forward. One of them would be to say, the most simple one would be to keep your cash at your favorite bank and say, I'm not willing to take any additional credit risk. I like the guys at this bank, they do a good job, and I'm going to keep my money liquid on call. The other options are to hold a range of fixed deposits with your bank, or to buy NCDs and try and manage around that process. Or finally, the real last option is to put your money, as a lot of you have been, in funds like the cash solutions range that you've got, and let professionals manage that process for you and try and get the best yield in the market at the time. So if we analyze these potential scenarios, I think putting cash on call at the moment is just hugely inefficient. At 4%, it's not giving you a great yield. It's flexible, but you're taking risk on one individual institution. And not that the banks are bad, because most of our exposure at the moment is to the big four banks. So I think you're pretty safe with a bank at the moment, but you're just really not making your money work by having it on call when you can get access same day or next day through other methods and a yield pickup. So at the moment, in my view, the choice really becomes between holding something like a fixed deposit or a longer dated NCD, and especially fixed rate ones, versus some sort of money market fund or income fund. So if we take an example at the moment, currently on the screens, I'm seeing for a 1-year fixed NCD, you're looking at about 4.9%. An income fund like the core income fund is currently yielding on a running yield 6.6%. So that's about 170 basis point pickup for a diversified bank risk effectively. And you then have 1-day liquidity. So, but obviously the question then says, okay, right, what's going to happen to this income fund's yield over the next while with rate cuts coming through and with the remaining 2% rate cut that's already through there? So our expectation is that the 660 will go down to about 550 with the current 2% rate cut coming through, because obviously the assets take a while to reset to the new interest rate. So the rate will decline to about 550. So and then if we anticipate, let's say, another 50 basis cut next week, we would then expect over an additional 3 months for the rate to come down a further 50 basis points to about 5%. And that would then that would still be higher than the current 4.9% fixed rate over here. So you're looking at a period of, let's say, 4 to 5 months of where you're on a very neutral basis between a fixed rate NCD and an income type fund. So really what you're trying to then say is, are rates going to come down much faster than let's say 50 basis points and another 50 basis points? Are we going to be seeing rates come down to where Nikki was talking about 1.7% inflation? Are they going to be able to take rates from 4% down to 2%? So is there another 200 basis points in the offing in a very short space of time? And really, we don't know. So the obvious or common logical expectation would be that yes, with inflation coming down, then rates would come down with that. But then we have to look at what are the conditions required for these further rate cuts. So yes, inflation is a major aspect of that. But are we 100% certain that inflation is going to come down to those levels? Is that not based on our kind of historical bias as to what's happened in the past? Yes, there will be, there's situations where the economy is not growing and oil prices have come down and that sort of thing. But those are not the only factors that affect inflation. What about things like the supply chain? Will there be situations where goods and services will become more sought after because a lot of businesses have gone under, and so prices may actually rise over the medium term? So I think just sticking with one view on the world and thinking that there's only one direction in these things. I know from 30 years of being in the markets that there's no such thing as a one-way directional thing. When everybody's calling something in one direction, you often get it wrong. And if everything was that simple, I wouldn't have a job. We would all be able to do this by ourselves, and it would be relatively easy. So I just caution against taking everything for granted that inflation will drop and that rates will drop. But you've got to go with the information that you have at hand, and it's looking like rates will go down, but just caution on that. And that's again coming back to that uncertainty. Having cash is something that you can then adapt to changing environment really quickly. So again, I'm not convinced that rate cuts may be as deep as we think they are at the moment. The Reserve Bank has a job to protect the rand, for instance, and so if things get very hairy, then they may have to keep rates where they are, or not cut as much as they need to. So overall, the choices that you have between going fixed and floating in an income fund, that income fund type of approach or using money market funds gives you that flexibility, because you are getting almost fixed deposit like yields, and you're taking a little bit of risk. You might miss out on 20 basis points here or there, but I think that flexibility gives you the ability to be able to move. And it's that flexibility and liquidity which is going to be king going forward for at least the next 6 months. And the next thing that's going to be king is the credit that you hold. So, Mike was talking earlier, and you can get a very good feeling from how he was talking about the banks being in a very good position from a capital perspective and from a liquidity perspective. So you really, I think, in this sort of environment, you have to trust the skills that are within the banks there to be able to deal with a crisis going forward. And the South African government has to look at the banking industry as almost part of the treasury, in a sense that this is something they can't let go. This is so important to the country in terms of providing liquidity, in terms of providing lending into the market, into a market that is very stressed. And so they become an integral mechanism for the government to use. So we don't really, nobody wants to see any banks going to the wall at this stage, and I don't believe that is anywhere near the case at this stage. We're looking at very strong banks, and that's why, almost the entire portfolio that we hold is in these banks. So really my story is, don't place all your faith in the experts out there. These guys trying to predict the future. Kind of use your gut instincts to guide you through this. You've already put a lot of your money in cash, and that's why you're listening to this call. So let your instincts guide you through this, because it's really about a survival process through this. And I think, getting a diversification of your cash through this and trying to still get a yield pickup in it is going to do you well through this thing. So thanks very much for listening.
Thank you, Ray. And just so everybody knows, the funds are well positioned, as conservatively as ever, but we do meet every single day with Taquanta, our best of breed manager. That's Cash Solutions meeting with Taquanta. And we remain on our toes. Things are changing very fast. There are many scenarios that can pan out, and I can tell you that the team is really watching closely. So that's it. That was the experiment of a speed insights session. Fortunately, the technology did remain connected for all of us, and we hope that you benefited from that. It was not a replacement for the Treasury Conference. It just so happened that we did it on the day of the Treasury Conference in memory of our Treasury Conference, but we might still hold that conference, as Ian mentioned in the beginning. Thanks to our presenters. The whole session has been recorded and will be distributed on our podcast channel and on YouTube. And as you know, we don't like to see lazy money around. So if you do have lazy money, let us know at Cash Solutions. Between us and our colleagues at Nedbank CIB, we can make sure that that cash gets put to work. Tomorrow, there's another insight session at 10. David Levinson with Robin Johnson will be discussing responsible investing beyond COVID-19 and releasing the results of our industry responsible investment survey. So that's it from us. Stay safe and feel free to contact us if you do need anything.